IFRS 15, also known as Revenue from Contracts with Customers, is a cornerstone accounting standard that dictates how companies recognize revenue arising from customer contracts. It supersedes various preceding standards and aims to enhance transparency and consistency in financial reporting by outlining a comprehensive five-step model for revenue recognition. Core principles of IFRS 15 are: 1. Revenue recognition at transfer of goods or services. Revenue is recognized when a company transfers the promised goods or services to the customer, not necessarily when cash is received. This principle ensures revenue recognition aligns with the value delivered. 2. Transaction price reflects expected consideration. The amount of revenue recognized reflects the total consideration the company expects to receive from the customer, including variable factors like discounts or bonuses. The five-step model for revenue recognition under IFRS 15 are: 1. Identify the contracts with a customer. This initial step establishes whether an agreement with a customer qualifies as a contract under IFRS 15. Specific criteria need to be met, such as identifying the rights and obligations of both parties and the existence of commercial substance. 2. Identify the performance obligations in the contract. Performance obligations are distinct promises made to transfer goods or services to the customer. Identifying these obligations is crucial for allocating the transaction price appropriately in the following step. 3. Determine the transaction price. This involves establishing the total amount of consideration the company expects to receive from the customer for the promised goods or services. It includes variable consideration such as bonuses or discounts. 4. Allocate the transaction price to the performance obligations. The transaction price is apportioned among the identified performance obligations based on their relative standalone selling prices. This ensures revenue recognition aligns with the value delivered at each performance stage. 5. Recognize revenue when, or as, the entity satisfies a performance obligation. Revenue recognition occurs when a performance obligation is satisfied, which means the good or service is transferred to the customer. In some cases, revenue can be recognized progressively over time if the performance obligation is satisfied over time. By adhering to this five-step model, companies can ensure consistent and transparent recognition of revenue from customer contracts, enhancing the reliability and usefulness of their financial statements for stakeholders.